Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Welcome to Target Market Insights. I'm your host, John Kasman, the founder of Kasman Capital Group, and I want to thank you for joining us for another great episode. Now, if you're enjoying the podcast, do me a favor, take a second and leave us a 5-star rating and review. And if you haven't already, make sure you hit the subscribe button so you don't miss an episode. Now, if you're interested in multifamily and want to review a sample deal, you are in luck. We have a special download on our website of a sample deal package. Just go to kasmancapital.com/sample deal, and you'll also join our mailing list to get tips and exclusive investment opportunities on what we're working on in the future. Now, today we're going to be talking to a West Coast syndicator who just completed his first syndication and already has another one under his belt. Kyle Mitchell is a real estate entrepreneur who just recently closed on his first multifamily syndication in May of 2019. Now, Kyle is also the co-host of the weekly real estate podcast, Passive Income Through Multifamily Real Estate, where he speaks with various experts in the real estate industry to help educate and create clarity for passive investors. Let's welcome to the show, Kyle Mitchell.
Thanks, Sean. I appreciate you having me on and honored to be on.
Absolutely, Kyle. Listen, I know we've been talking for a little while now, and it's really great just kind of watching your growth. You did close that first syndication. I know you've got other deals in the works right now. Let's start there, man. What was it like to close on that first syndication?
It was great at the end, but a whirlwind while I was going through it. You know, there's just so many things going on at once when you're doing a syndication, and the timing of things is very important. And whether that's your legal docs, your earnest money deposit, due diligence, dealing with the lender, everything needs to happen within a couple week time frame in order to get it closed. And that was something that was a huge learning curve for me and definitely a whirlwind while it happened. But it was an amazing experience, and I'm ready to do it again.
Excellent, man. Well, congratulations again. You talked about the time frame being compressed. I mean, how did you manage that? I mean, was that you kind of solo running everything? Did you have a team that you were working with, or how did you kind of manage that time crunch?
At first, it was just me, and that was probably my biggest mistake on the deal, was trying to do it all on our own and get the deal closed. We eventually did bring on team members to help with it. But I am the type of person that just likes to have everything planned out and have a schedule. And I think without that schedule and having everything kind of detailed out and lined out, it would have been a little more challenging.
Awesome. Well, congratulations again. Kyle, let's get into a little bit of your background. Why don't you take 30 seconds and tell us more about who Kyle Mitchell is?
Yeah, sure. Originally, I was in the golf industry, and I was a general manager and a regional manager for a golf management company. So you can liken that to a third-party property management company where the municipalities or the cities will hire a property management company to come in and manage their properties. So it's the same type of thing. You just switch that over to real estate. So I did that for about 15 years. I found real estate through just passively investing first in single family homes and wanted to scale my business. So I found multifamily, and I love the business metrics and the business behind it, right? Drive the income, control the expenses, and then there's a multiple based on your NOI and the cap rate in the market. So I love that. That's kind of my business background, and it matches well. So we focus on syndications in the Arizona markets in Phoenix and Tucson.
Okay. So you started investing passively in single family homes and then wanted to scale into multifamily. Did you transition by investing passively in multifamily first?
No, I never invested passively in multifamily. And when I say passively in single family homes, let me kind of reiterate that. It was in turnkeys. And so it wasn't necessarily passive, but it was as passive as it gets when you're buying your own kind of turnkeys. We've got a third party property management company. You buy the property that's already rehabbed and fixed up for you.
What markets were those turnkey rehabs?
So right now I still have them, and I'm trying to sell them off to put my capital back into multifamily, but they're in Arkansas, just outside of Chicago, and Ohio.
Got it. So, wow. Okay. Well, two of those markets, I know very well in Ohio and Chicago, Arkansas, not as much, but you are out there on the West Coast and I believe near La Jolla, right? Somewhere out that way?
Southern California. Yep.
Southern
by
Cal.
LA.
Okay. So what what made you invest in Arkansas, Ohio, and Chicago?
Arkansas was my first investment out of state. Originally, I invested in some single family homes in Southern California, had a bad experience. It's not a landlord friendly state, which is one of the main reasons I sold that property. And I told myself, I'm going to buy in the most landlord friendly state there is, and it happens to be Arkansas. One day late on rent, and you can get them out. And so, uh, cash flow is decent out there. And, knock on wood, those properties have done really well for me thus far.
It's interesting to hear. I did not know Arkansas was really one of the most landlord-friendly states. Um, so that's really interesting to note. So you did that one, and if that seemed like it was going well, why did you start to spread to Chicago and then Ohio?
Yeah, I think it was just diversification. I listen to a lot of podcasts. I go to a lot of seminars, read books, and you want to diversify, even not just within asset class or outside of asset classes, but within the asset class itself. So we targeted 3 different markets where we want to expand, and that's kind of how we did that. But we wanted to just diversify. So if something went wrong with, let's say, Chicago, because that's where I'm having the most issues with my single family homes, my whole portfolio doesn't go down with me in flames, right? So those houses aren't doing great right now, but I have the other 2 markets where they're doing well, and so that kind of keeps me above water.
I think that's a great strategy, right? Even as you look at multifamily, if you're going to invest, diversification is the name of the game, right? You want to make sure you're investing both assets as well as markets. And if you love an asset class, I think one of the best things you can do is maybe diversify within that asset class, looking at different markets. So to your point, if you've got deals in Arkansas, you've got deals in Ohio, you have deals in Chicago, you can, each deal can have a different goal or metric or, role in your portfolio, but they're not necessarily all tied together. Now, sometimes they will move in conjunction with the market, but a lot of times you can have a little bit of flexibility there too. So you did that, and then you said, you know what, I would need to scale this thing. This is, just a couple single families here and there. Let's go up to multifamily. What was that process like? What was the first thing you did, and what was that step into making that transition into multifamily?
Yeah. So, ultimately what I wanted to do was build up, at that time, it was $10,000 a month in passive income. And I just figured the way it was going with the turns and things with single family home, it's going to take 50 to 100 single family homes. So I said to myself, this is going to just take way too long. What else is there? So just by listening to podcasts and talking to people, this was probably 2 years ago now. Multifamily was getting hot, right? So there was a lot of stuff online that you could read, and we found an online mentorship program that we was pretty cheap at the time, and we took it. And this was before we actually decided. And when I say we, it's my wife and I. And
My wife and
before
I,
my wife and I, yeah, it
yeah,
used to be
newlywed.
fiance, my
Yeah.
fiance at the time.
Congratulations again, man.
Thank you. So at that time, we weren't sure we were going to go into multifamily, to be honest, but we purchased this online program, and we were serious about taking the next step in some type of vehicle. And since I had previous experience investing in real estate, it made sense. And then once we took this online program, it just clicked in my head,
Mm.
with the whole business metrics of multifamily and how it works. It just totally made sense. I fell in love with it, and we kind of just went on from there, and took some coaching for about 6 months, and just ate up as much education as you can possibly have in a 12-month span.
I think that's awesome, man. So you still weren't 100% convinced when you signed up for that online mentorship, but you did it anyway. And from there, it really started to crystallize. And then you basically doubled down on the education, doing some coaching, listening to everything you can before kind of pulling the trigger. What was it going back to that online mentorship that you saw that made you say, hey, you know what? Even though I'm still on the fence about whether or not this is the right avenue for me, let's go ahead and pay for this education to make this move and at least to help figure out what we want to do next.
It's just how much I learned in a short amount of time and how much I understood it. And, I think when a lot of people look at my career, they say, oh, was in the golf business. How did you transition so quickly into real estate? But I think at the same time, a lot of what I did as a regional manager for my golf management company transitions very well into multifamily. A lot about multifamily, everyone thinks, oh, it's just buying apartments and fixing them up. But no, there's a deeper level to that. You need to manage the managers. You need to make sure that the managers you hire have the right systems in place and that they're following kind of your business plan, right? And so that's what I did. We hired and fired and drove revenue and implemented systems. And so the transition was very easy for me. So when I saw that online program, it was just speaking my language. And so it was very easy for me to transition and just know that that was the right way to go.
I think there's a couple lessons there. First and foremost, you saw an opportunity. You were willing to pay for the education, even though you knew there's a lot of free stuff out there. You were willing to pay for the education, and that was kind of the I don't want to say final test, but that was your way of knowing, hey, yep, this is exactly what I want to do, and I'm willing to pay to get that knowledge and do that. The other thing that really stands out to me is the transferable skills from your corporate job. A lot of times when you get into syndication, as you know, it's not that you have to be a real estate guru. You don't have to have a background in construction. You don't necessarily have to have a background in finance or something in the real estate industry. There are a lot of transferable skills if you understand management and leadership and putting teams together, overseeing teams, putting deals together, structuring things, and ultimately being a problem solver. If you can figure out those things, then there's roles for you to play in the syndication business. So I think that it's really good to hear you talk about what those steps were. And then finally, you took action. You did a lot of listening and learning, being a sponge for the 12 months, hiring a coach and going through that process. But ultimately, you were loading yourself up, being ready to go. So let's kind of fast forward. You did the coaching, you did the training, you did the education. At what point did you feel ready and confident to pull the trigger on that first deal?
It was about probably 11 months after when I quit my job before we had our first
You
deal.
quit your job before you had a first deal.
Yeah, and I wouldn't
Oh,
suggest it
wow.
to everyone. This was something that I had been planning on for 2 years, that I wanted to leave my job for another career in another industry, something that I can help build long-term wealth with. And when I found it, I just knew it was the right thing. But it did take 11 months to build our investor list, feel good about it, and build our network. But left my job, and about 2.5 months later is when we found our first deal, which is, I think, a testament to the fact that when you're full time, you could just dive right in. We would be going to the markets, maybe once every other month when we had our jobs. But now that I'm full time, I'm actually out in the markets every other week, at the least every week, almost.
Awesome, man. Great tips there. And I love the confidence to quit and go full gung ho on it. I do not recommend that for everyone
Correct.
because if you didn't find that job, at a certain point, I'm assuming you had some savings put aside and things like that. But those things do run out if you go a long time without money coming in. But no, I'm glad you got that. So let's talk a little bit about kind of some of the challenges you faced in structuring that first syndication. So your first time out, you had the 15 years experience in the golf industry, but you're still your first syndication. Um, Explain to me what challenges, what pushes did you receive from other investors, as well as brokers or even lenders in going through your first syndication deal?
Yeah, I had a challenge with all those different things, and I think the first one was the broker who I had built a relationship up with for about 6 months asked me, Kyle, why are you ready to close on this deal? This is your first deal. How do you know that you're going to be able to bring the money to the table? And that was just talking through, what we were doing for the last 12 months. We had started several meetups. We had started a podcast. I had quit my job. I mean, you just had to convince them. And that's what I did. And I think the fact that they saw that I left my full-time job to pursue this, they knew I was serious. So I was going to do whatever it took necessary to close the deal. The next thing that was a challenge was, I think I mentioned it earlier, was we tried to kind of do it all on our own. It was a smaller deal. It's a 42 unit property, 1.65 total purchase price. But the raise was 1 million because we had to put 35% down. We're putting, three or $400,000 into the property. So raising $1 million on your first raise, I would say we felt like we can do it, but we weren't sure. And so about 3 weeks in, we realized, hey, we may need some help here. We had raised about half the money, and ultimately, I think we could have done it, but I wanted to make sure that we could raise all the money, because if you don't raise all the money in multifamily syndications, at least the way we do it, you can't execute your business plan. Okay, we raise all of our capital up front so we can make sure we execute the business plan. So we don't utilize the cash flows from the property to put back into the property, because what happens if your cash flow dries up? Now you can't execute your business plan. So we just wanted to make sure that we could do the full raise. So we did at that point bring on some partners to help with asset management and to sign on the loan. And that was actually the biggest challenge. So I had communicated through the phone that that was our plan with our mortgage broker. However, I don't know what happened, but something fell through. So I should have probably done this over email and been a little bit more clear with what our business plan was. But originally it was about a month in, if we weren't feeling comfortable with the deal, we'd bring on partners. Well, when we asked to do that, they had already submitted our loan docs and everything and our application to Freddie.
Yeah.
And so at that point, they've got to re-underwrite the whole team. It was too late. So they said, Kyle, there's nothing we can do. It's too late. You've got to go it alone. So I basically made my emergency phone calls that you and I were talking about earlier and said, hey, who can help? What can we do? And 29 days before close, and this is after we used our extension, so this is the last 29 days, found a lender that said we can do it. I ended up jumping ship on that current lender, which was, unfortunate, and I think they understood. But went with a new lender, ended up going Fannie on this one, had the couple partners come in, sign on the loan, help finish out the raise, and now we're partners on future deals too now. And ended up getting an 81 basis point discount on the interest rate in the meantime. So everything worked out, but that was probably the most stressful 30 days of my life because we weren't even sure going with the new lender that we were going to be able to close in the 29-day time frame. But it ended up working out for the best. And now I understand how everything just needs to be done in the front end. You need to build your team on the front end, no matter what. You need to have all your ducks in a row so that the lender is fully aware of what your business plan is.
Yeah, I think there are a couple of big takeaways. One is, what you have to understand with the lenders are that they are, they're very cautious and they don't like change and they definitely don't like surprises. So, if they're operating under one pretense and, something pops up that's different than what they expected, a lot of times they freak out and the difference is either changing the interest rate or, hey, we can't do the loan, or, hey, you got to stick to what we originally said. But they're banks and banks are going to be very cautious on the terms that they set. So it's great that you had some time to kind of navigate, find another lender who's willing to come to the terms. It's phenomenal that you were able to get an 81 basis point discount on your interest rate. But let's talk a little bit more about how you found those people. You're basically in the ninth hour. You go through your mental Rolodex or your database. You make the phone calls. How did you know that these people were interested and would be able to come to partner with you on this deal?
I didn't, to be honest. And I had already, so this was 3 weeks in trying to figure out what we were going to do. And I felt like I had already called everyone I had to. I had one partner that was going to come on board and help finish the raise and do asset management with me. And he did. But the other person that we were trying to find was someone to sign on a Fannie loan. And to sign on a Fannie loan, you either have had to do that before or had 2 years of experience in multifamily. And so most of the people I know have a year and a half, but maybe even a couple of years, but they haven't signed on a loan or just didn't want to. So I just went through everyone. I know quite a few people from our meetup. There was one person that I hadn't asked yet, maybe because I was feeling a little uncomfortable. We had tried to do a couple other deals in the past, but nothing ever kind of worked out. And so this person was kind of just a Hail Mary. I called him and I said, hey, this is what I'm looking at. Can you help out? Are you interested? And he said, yeah, I'll help out. And actually, let me make a couple phone calls and see if we can find another lender for you. Actually, that was the original reason why I called him. And so he was able to find the lender. He called this guy. We're in the West Coast. He called on a Friday night at 7 p.m. West Coast time.
Wow.
So 10 p.m. East Coast, got a hold of the guy. The guy's like, send me the stuff. If we can do it, we'll do it. And on Monday we had it done and he said, hey, I'll sign on the loan for you too. So
wow.
The lesson I learned from that is just call anyone you can when you're in a pinch, and you never know who's going to be there to kind of pick you up and save you.
Yeah, I think too, man, the thing about this whole, syndication and what makes it very different from almost every other aspect of both investing and business that I've seen is it's very collaborative. If there's a deal and there's an opportunity and there's a win-win scenario that can be created, people are willing to help you. So, a lot of times whether it be ego or for whatever reason, we don't want to reach out to folks in our network or our database for whatever reason, um, don't hesitate to at least build a relationship, start a conversation, because you don't know who may be able to help you in the future or maybe who you can help in the future. So it's good to at least have that initial conversation, because I'm assuming that you've had different conversations with this individual. It wasn't like the first time you were calling. So while it was a bit of a Hail Mary, it wasn't someone who you didn't have a rapport with or relationship with. And I'll tell you, I mean, one of the things that always bugs me is from time to time, I'll get a call from people who I haven't ever met or ever talked to. And it's, hey, I've got this deal. Can you help me? And the answer is no, I can't, because we need to get to know each other. There needs to be a relationship. We need to get to know what you look for, what I look for, and we got to build that rapport. Because ultimately, if I'm taking this to folks that I've met and I've built relationships with, there's a trust that's expected. And I think you got to take that time to build the relationships. And, I would just say, again, for anyone listening, if you're looking to get a syndication, if you have deals, if you, even if you were raising a great amount of money for your deals consistently, you're raising multiple millions of dollars, you should always reach out and build relationships and connections with other folks, because there may be a time where you need that relationship. And, just calling a guy because you heard him or whatever, that's not really the best way to build relationships. So get to know people. And again, if you can help each other, great. I think we all are trying to be very supportive and helping each other where we can. But you've got to build the relationships. I think that's the key part about it. So Kyle, with that said, you are doing a lot of things to build relationships. You have multiple meetup groups. You've got your podcast that we talked about. Talk to me more about kind of the importance of building out some of these educational platforms.
Yeah, those have been the key to my success, and it started with me getting out of my comfort zone for sure, and starting these things, because I never really felt comfortable talking in front of a crowd. But I knew that if I wanted to make my stamp in this industry, I would have to be doing those things. All the top guys in this industry are doing this type of stuff. And so I said, hey, I've got to jump in and start it. So the first thing we did was partner with someone who already had a meetup, and we just built out another chapter. And so he already had a small following that we kind of jumped on, and that's since grown quite a bit. Now we have 3 meetups. One I have in Phoenix, actually. So we're going to fly to Phoenix on a monthly basis and meet people out there. And then we started our podcast. But if I didn't build these things prior to me leaving my job, I would have never left my job, because we wouldn't have had the network that we did. So there's a difference between going to a meetup and being a part of a group, or hosting that meetup and being the head of the table and being the one providing value and helping other people, educate themselves on that space. So it's been tremendous for us.
Yeah, I think the thing there is, you talked about it being uncomfortable, right? I mean, for some folks, they imagine that you have to have this big, over the top, larger than life personality to launch a podcast or host a meetup or whatever. And that's not necessarily the case. You have to be personable, obviously, but you don't have to become someone you're not. If you're mostly a quiet or shy person, I think it's fine to still do these things, because it's conversations. At the end of the day, what you're really doing is you're having conversations with people, and you're educating, you're sharing your knowledge, you're presenting opportunities in a way where people can learn more about yourself, what you do, but also the things that are important to them. So, you kind of have to get out of your own way, become a bit uncomfortable, and find ways to build those relationships and build those bridges to folks who can help you build your business. Kyle, so one thing that I've run into with my business, and I'm curious to hear your take on this, is we often, especially with our meetup, we have a lot of active investors who participate in the meetups, and not as many passive investors. So as you're looking to build up and really connect with passive investors, what have you done to either attract more passive investors or to figure out how to leverage that meetup to really engage those passive investors?
Yeah, so we do have a lot of active investors at our meetups as well, and or newbies, right, who are just not ready to invest. I mean, you definitely don't want to take money and have someone invest on their first deal when they're not even sure, how real estate works or an investment works. So I would say in the beginning, 90% of our attendees were those people. But as you build out your network, people start to learn more and more what you do, and they're more interested about it. So, we communicate with our meetup groups outside of the once a month meetup. And that's what's been the best thing for us. So we have a monthly newsletter that goes out every month. We also have a drip campaign that we've created. So it's a 20-month drip campaign. So basically you're getting 2 emails from us. And as you're getting the emails, it's educating you on what we do. And so now more and more people are interested in what we do from a passive standpoint. And so they're going to be more interested in coming to our meetups. But I think at first too, when I was starting our meetup, I was more concerned with how many people came. So I didn't care who was coming. I just wanted a big crowd. And now I would rather have, 10 people who are focused and really want to learn and educate themselves on what we're trying to teach them and educate them on. So it's kind of been a mind shift or a shift in our mindset as well. And then on top of that, we also host monthly webinars, and these are geared towards passive investors. And then from there, we'll let them know about our meetup. So it is a constant educational journey for sure, and you're constantly telling people about what you do. But it's just been a mindset shift for us.
What's the content of the meetup? I mean, what's your structure? You mentioned education a few times. Are you educating them on terminology, deals? What exactly are you doing at those meetups?
Yeah, all of it. When we first started out, it was basically going through the steps that we took to get to where we were, because we were not comfortable talking about something that we hadn't gone through.
Right.
And this goes back to what you were saying, is that you don't have to be a master at what you do in order to start an educational platform. You just want to make sure that you're guiding people in the right way or doing things that you feel comfortable talking about. And there's millions of things that you can talk about. So first thing we talked about was how to pick a market, because that's what we did, and how to talk to brokers and how to find brokers and how to analyze a deal at a very high level. We would bring in people who do a case study on multifamily deals to see that. And it just creates a buzz. And, we do things like a small mastermind where we'll break up into smaller groups. They talk to one another about what they're working on and how the group can help and how they can connect them with someone that maybe they're looking for. We'll bring in a property management company to talk about, how to find the best property management company and how to deal with your renovations. But now they're more geared towards finding passive investors. But we just focus on adding value, So if people are asking us on the meetup group page to, do a webinar for underwriting so they can learn how to look at a deal, that's what we'll do. We want to add as much value as possible. And that's the point of these meetups. Ultimately, we want to find some investors from them. And, that's one of the things. But I think the number one thing that we want to do is help other people and add value to other people.
I love it. All right, Cal, are you ready to transition to our Bullseye Round?
Let's do it.
All right. What is the book you've recommended or gifted the most in the last year?
Miracle Morning by Hal Elrod.
Great book. All right. Give me a digital or mobile resource you recommend for your business.
I just currently started using HubSpot, which is the CRM. I didn't use a CRM before, and I'm teaching myself how to use it. And I love it because it tracks emails as well. So I can tell when someone opens an email, and it also just filters all my communication straight into the CRM, so I don't have to plug in everything.
All right. What is a daily habit that helps you stay focused on your goals?
Going to the gym. Every morning I go exercise for a run or a workout.
What's one thing you know now that you wish you knew when you were starting out?
That lenders are tough to deal with and that you need to make sure you over communicate and have everything lined up prior to doing it.
Yes, someone trying to give you millions of dollars is going to ask a lot of questions.
Yeah, exactly.
I love it. I love it. All right. What advice would you give a smart-driven college student about the real world?
Just go do it, take action, and get out of your comfort zone. That's something Lalita and I, my wife, do 3 or 4 times a year now, is try and get out of our comfort zone. And it has made us grow exponentially.
Awesome. What advice should they ignore?
All the naysayers. Just, anyone saying that they can't do it, it's probably because they've never done it. And so you should not be taking advice from people that have never done what you're trying to do.
How has a failure or apparent failure set you up for later success?
I now am able to take a look at a failure and understand that it's a learning experience. And so no failure is a failure anymore for me because I'm growing and learning from it.
All right. What are you curious about right now?
I am curious about, well, this is totally off subject, but playing tennis. My fiance or my wife and I want to get into playing tennis. So that's what we're looking into. I know it's a random answer, but
No, the golf guy now wants to play tennis, so it's
that's right.
interesting. I love it. I love it. That's cool. Couples tennis, I'm sure you'll knock it out. All right. So I know we talked about you being in SoCal. Give me the best place to grab a bite in your city.
Oh, in SoCal, I was going to answer in Arizona. In Arizona, I would say Raising Cane's. They also have that out here.
Okay.
Man, out here, there's so many good spots. You threw me off because I was going to say Raising Cane's for Arizona. I say In-N-Out Burger because I just had it this weekend, and it's not on the East Coast. And if you have a chance, definitely take a look at In-N-Out Burger out here.
Absolutely. Absolutely. Got that secret menu where you can order animal style or something like that.
Yep.
Yeah, exactly. Love it. All right. So look, we talked a little bit about kind of that first syndication deal. And I know that you are working in Arizona. I want to kind of come back with a couple more follow-up questions. Why Arizona? And I know you're in both Phoenix and Tucson. So being in Southern California, I'm curious to know why you decided to focus on the Arizona market.
Yeah, a couple things. It took us a while to find that market. Originally, we were looking in Ohio, Columbus, Ohio. We loved that market. All the rent growth, job growth, all those metrics were there. And what we found, especially when we first started out, I had a full-time job. So getting to Columbus, Ohio was not easy. Time change, doing it on the weekends, or having to take vacation from my work. It was really difficult. And really, if you're going to fly out there, you want to spend a couple days out there, meet with the brokers. And so it just became too difficult for us to make it out to that market. So we started thinking, okay, what's a little bit closer and still a great market? And so to us now, we look for proximity as one of the metrics, not all of them, but one of the metrics that we look for in the markets that we choose. And so Phoenix, I can drive there in 5 hours, 4.5, 5 hours. Tucson does take 7 or 8, but you can fly to both in about an hour and a half. So there's no time change. I can be there at 8 a.m. if I'm flying and back at 10 p.m. and I could have an entire day in that market. And so I was able to get a lot more done. And on top of that, it's a pro-business, landlord-friendly state. Rent growth is number 1 in the nation for tier 2 and tier 3 markets, which is Phoenix and Tucson. Job diversity out there is fantastic. Rent growth, job growth, population growth. I mean, everything that you want in a market is what Arizona is right now.
Awesome. Great information. I think that's a really important factor, right? So we can look at all the data points we want about the best places to invest, but the real world aspects start to kick in. Where are you located based on where the property is? How frequently do you need to fly out there? How long is it going to take you to actually get there? Where's the nearest airport? So there's all those kind of things that don't necessarily show up when you're doing your research on emerging markets. But we think proximity is an important thing too. We love the Midwest. I mean, we're based in the Midwest, and we think about it for the same reasons and look for the same things as far as the growth, the diversification in the market, different employers, and I think also proximity, right? So how easy is it going to be for you to get out to the property? And it doesn't have to be you, but whoever is going to be the main asset manager. We like to make sure that person can get over to the property fairly quickly. Kyle, lots of great information, man. I really appreciate you sharing your journey, your story about how you went from, being a golf industry pro, really focusing on, starting with the single family homes, transitioning into multifamily, the steps you took to educate yourself, to get yourself prepared, doing that first deal. And now you're kind of off to the races with new deals in the pipeline. So congratulations on that. And more importantly, or I should say most importantly, congratulations on the wedding, and say hello to Lalita for me. And you've been a great guest. Thank you again for coming on the show, and hope to talk to you again soon.
Yeah, thanks, John. Appreciate it. Had a lot of fun.